let's talk about options trading and how I will be adding them to my multiple passive streams of income game plan. Hey, this is Rochelle and welcome to Multiple Passive Streams of Income. Options are not new to me. In fact, my boy Chris Clay opened up my eyes to them about 15 years ago. But at the time, trading platforms were not as advanced as they are today. And the particular strategies that I was looking at that time, the cash outlay was a little bit too steep. And the duration of the trades made me move away from the idea. But recently, my interest was piqued, so I refreshed my knowledge of the subject matter and I started to investigate different option strategies. So let's just start out with some basic understanding so that we all are on the same page. And then I'll go into the first strategy that I'm looking at. So first of all, what is an option? A lot of stocks and indices have options. If you go to any stock platform on the screen, I have Yahoo Finance and I'm looking at the stock Tesla. And as you can see, there is an option chain for Tesla. Now, Tesla has weekly options, but depending on the stock or the index, the option may be quarterly or weekly like it is for Tesla, or they may have weekly options that expire 3 times a week, like the index SPX, which is the S&P 500 index. Now, let's look at some information on this Tesla option chain so you can get acquainted at what you're going to be looking at. The first thing is the price of Tesla when the markets closed Friday, October 22nd. The price is $909.68. Now, this option chain on the screen is the October 29th option chain. So that means that any option trades utilizing this October 29th option chain will expire at 4 p.m. on October 29th. Now, I put the definition of an option on the screen, but I always read that definition and it doesn't make me understand anything better. So let's just try to simplify it. An options is just a contract. Let's use a real world example. Now, some people rent homes with an option to buy. So what does that mean? Let's say you wanted to buy the home that you live in, but you don't own it, but your credit sucks. And you believe you can clean up your credit in 2 years, but you know the house will cost more in 2 years. So you ask the landlord to rent with an option to buy the home for today's price, which is $300,000. Now, some option to buy contracts will have upfront fees. So your landlord may say, okay, I'll go into this contract with you if you give me $2,500. Or sometimes the person doesn't have the $2,500, so the landlord will just say, pay me $100 on top of your rent each month. And the money ensures that the landlord doesn't sell a house in those 2 years and allows you to buy the house within 2 years. So he or she has to sell it to you also at that agreed amount of $300,000. Now, as the word suggests, you have the option to buy it. So if the market drives the price up to $400,000 in those 2 years, the landlord has to sell it to you at $300,000. And vice versa. If the property market price decreases to $200,000, you would not have to exercise the option to buy it at $300,000 because, of course, why would you buy a house at $300,000 that's only worth $200,000? In either case, the landlord keeps that $2,500 or that extra monthly $100 they have been collecting from your rent. So how does this fit into the stock market? Well, people buy and sell options to speculate or hedge. I wouldn't get too fixated on the reasons why, because there's so many reasons why people buy and sell options. Just know that people can buy and or sell options. Now, the next important definition we need to understand is a call and a put. A person buys a call option because they feel the price of the stock is going to rise above the strike price before that option expires. And conversely, a person buys a put option because they feel the price of the stock will drop below the strike price before the option expires. So, of course, the next question is, what is a strike price? We're going to look at an option chain for Tesla, and I have the strike prices outlined below. Okay, so now what do we need to enter an options contract? We need 4 pieces of information. The first piece is, what option are we trading, right? So in this case, Tesla, or in the case of the landlord and tenant, it was the house that they were making this options contract on. The second piece is, when is this contract expiring? Okay, so right now we're looking at the Tesla October 29th option, right? In the example prior, it was a 2-year expiration date, okay? The other thing is, we need to know, are we buying or selling a call or a put option? And this is going to be determined on what you believe the stock or the index price will be on or before October 29th. If you're the buyer and you're bullish, you're going to buy a call option. And if you're bearish, you're going to buy a put option. And the last piece is the strike price, which is the agreed upon price at the time we enter the options contract. So that row of strike prices is what you're buying. That's the price that you are making your expectations about. And in our example earlier, $300,000 was the strike price of the house at the time that we entered into that options contract with the landlord. We can buy or sell many different strike prices. So again, without getting too technical, let's just look at an option strategy that I'm currently backtesting. And I'm going to get a little techie, but just stay with me because I'm going to show you a picture illustration. So what happened in 2018 is that the SPX became an index that has weekly options that expire on Mondays, Wednesdays, and Fridays. Now, I find that appealing because I would rather not have to be in a trade for more than a day. And this strategy that I'm testing is going to involve an iron condor. So an iron condor is a 4-leg option play, which involves 2 vertical spreads, a put spread and a call spread with the same expiration date. And let me just show you what that looks like. So I'm testing out this software called Option View, and I'm looking at the SPX. I have the back tester set at 9:30 a.m. on Friday, October 22nd to illustrate this. And the price of the SPX is $4,546.70 at 9:30 a.m. Now, this strategy looks at the option chain for SPX, and we're also looking at the delta of 10 or less. And we're going to put in option trades, 2 on the call side and 2 on the put side. So let's just start out with the call side first. At the 10 or less delta, the call strike price is $4,590. So I'm going to sell 4 contracts at that price. The second leg of this call part of the options trade, we're going to buy 4 contracts, 2 strike prices above that delta 10 or less strike price, right? So we already know that price is $45.90. So we're now going to buy 4 contracts at $4,600, and that's the call strike price. Now let's do the same on the put side. We're going to locate the delta 10 or less on the put side, which is $4,500, and we're going to sell 4 contracts of that, and then we're going to move 2 strike prices down, which will have us buying 4 contracts of the $44.90 put strike price. Now, before we move ahead, let's just go over why we're looking at delta and what does that mean. And delta, in essence, gives us a percentage of the probability that index price will go above the strike price of the call option or below the strike price of a put option. So for us to make money, we want the index price not to exceed the inner leg strike price of the 4-leg option, which is the iron condor. So this is why we pick strike prices of 10 or less delta to give ourselves a 90% or better chance of winning this trade. So how much does this cost us? What are we risking? What can we potentially win and lose, right? So the software tells us we can earn $60 by risking $3,940. But we also have a 90% chance of doing just that. So let's look at a picture of what that looks like. I have a chart up of the SPX. As long as the price of the SPX stays between $45.90 and $4,500 by the end of the day, all the legs of the iron condor expire worthless, and we keep the $60 gain from trading the 4 contracts that make up this iron condor. If the SPX price goes above or below the inner legs of the iron condor, that's when we are in jeopardy to incur a loss. Again, we don't necessarily lose everything, which is the $3,940 that we have to make this trade. So technically, we can lose less than $3,940, but the maximum and the most that we can lose is $3,940 if the price goes above the second leg of the iron condor or below the second leg of the iron condor. Let's move the back trader to 1630, which is 4:30 p.m. and the delta worked as we thought it would, and the options expired worthless because the price never went above our call inner option play, and it never went below our put inner option leg. So that trade resulted in a $60 win. Now, $60 wouldn't be enough of a gain to enter this trade. But many days, the potential gains are 3 to 6 times higher. So when those occurrences happen, the trade works the same way. It just would be more of an amount that you would win if the trade is favorable. So I'm currently backtesting this strategy. The reality is that although there will be many winning days due to the high probability, right, 90% chance of winning, in the short trading duration, just one day, but there are going to be times when there are rare losses, and they will wipe out many of the consecutive wins. But backtesting will allow me to determine if this should be one of the option strategies to employ. So in next week's video, I'm going to concentrate on the results of the backtest and let you know my final decision on this options strategy. Please subscribe and comment. And do you think that options can be an income stream for you? Please let me know. Smash the notification bell if you like the content. Please like or dislike the video because all interaction counts. And as always, thanks for your time, as I know you could be any other place right now. Take care.